Every liquidity concept splits into two families. On one side, you have price action liquidity, what you can infer just by looking at the chart, the swings and pulls and gaps. On the other side, you have order flow liquidity, what's actually happening in the orders themselves, the volume, the footprint, the heat map. Retail lives on the first side, institutions live on the second. We're going to cover both and then show you where they overlap. So how does price actually move up a level? Simple. Buyers send in enough market orders to eat through every sell limit order sitting at the current ask. Once that level is cleared out, there are no more sellers there, so the best available price becomes the next level up. Price didn't drift higher, it got consumed higher. Someone ate the liquidity and the price ticked up to the next resting orders. Every move is that, over and over. This is the real definition of liquidity, and it's not complicated. Liquidity is just market depth, how many resting orders are sitting at each price. Deep liquidity means lots of orders, so big trades barely move the price. Thin liquidity means almost nothing resting, so even a small order sends price flying. When people say a market is liquid or illiquid, this is what they mean. Depth, that's the whole word. Left to just buyers and sellers, the spread would often be way too wide. Each side refuses to cross to the other. Enter the market maker. They continuously post limit orders on both sides, inside the spread. They compete to offer a slightly higher bid and a slightly lower ask, which narrows the gap. Now sellers can hit the bid, buyers can lift the ask, and the market flows. Their profit is the spread itself. Buy the bid, sell the ask, over and over. They fill the gap the crowd won't cross. Market makers can also shift the whole bid-ask structure up or down, and that's called skewing. Skew it down and the lower ask quietly attracts buyers while the lower bid pushes sellers away. That tilts order flow slightly in one direction without a single big market order being fired. Now here's the honest part. Most of the time this is just inventory balancing, the maker managing their own risk. What looks like manipulation is often just a firm keeping its book neutral so it can keep quoting. The phrase market maker actually means two totally different things, and mixing them up will confuse you forever. The first is the microstructure maker, a genuine liquidity provider who posts on both sides, earns the spread, balances inventory, and only nudges order flow subtly. That's the real technical definition. The second is the smart money myth, this idea of one giant trader always a step ahead, writing entire trends at will. That second one is a storytelling term from technical analysis, useful as a metaphor, but don't confuse it with how the market actually works. Let's lock in the full picture. Every order sits at the intersection of three dimensions. By function, market orders consume liquidity, limit orders provide it, stop orders are potential consumption waiting to happen. By visibility, market orders are invisible until they execute. Limit orders are visible in real time but deceptive. Stops are invisible until they trigger. By behavior, market orders are pure urgency, limits are intent without commitment, stops are conditional urgency. Master this one table and every liquidity technique later becomes obvious. Here's the paradox that trips up almost everyone. Limit orders are the only order type you can actually see in real time. They show up as depth in the book, but they're deceptive because they can be modified or cancelled in a millisecond. Presence isn't intent. Meanwhile, stop orders are invisible, you never see them until they fire. But traders place them in obvious, predictable spots, just past the swing highs and lows. So the visible order lies to you, and the invisible one tells you exactly where it's hiding. Before we go deeper, here are the building blocks you need. A swing point is a local high or low where price turned. A range is the area between a swing high and a swing low. A pullback is a smaller counter move inside a bigger trend. A pool is a cluster of orders, usually stops, sitting at an obvious level. And a void is the opposite, an area with almost no resting orders, where price can move fast because there's nothing to slow it down. Pools attract price, voids let it run. Now the two most important pools. Buy-side liquidity is a cluster of buy stops sitting above a swing high. Who's parked there? Short sellers' stop losses, plus breakout buyers' entry orders. Sell-side liquidity is the mirror, a cluster of sell stops below a swing low, made of long holders' stop losses plus breakout sellers' entries. Both are pools of stops, And stops matter because when they trigger, they fire as market orders, which means they hand the other side a big burst of liquidity to trade against. A sweep is when price pokes just past a swing point, triggers the stops resting there, and then reverses. It looks like a breakout, that's the point. It's deceptive triggering. Price nudges above the high, everyone's buy stops fire, the breakout traders pile in long, and then price snaps back down and traps them. Those trapped orders become fuel. The sweep isn't the move you want to trade with, it's the move that shows you where the real move is about to come from. These three get used interchangeably, but they're different. A sweep is a quick poke past a level that triggers stops and reverses. A grab is more deliberate and often deeper. Price reaches in, takes the liquidity, and turns with intent. A run is when price doesn't reverse at all. It clears one pool and keeps going, running from one liquidity target to the next. Sweep and reverse, grab and turn, or run straight through. Reading which one you're in tells you whether to fade the move or ride it. Zoom out and liquidity splits into two zones. External liquidity rests outside the range, beyond the major swing high and the major swing low. Internal liquidity sits inside the range, all the minor pullbacks and minor swing points in between. Here's the pattern that matters. Price very often sweeps the internal liquidity first, using it as fuel, and then makes its real run toward the external liquidity. Inside first, outside second. Once you see that rhythm, a lot of choppy price action suddenly makes sense. Inducement is the sharpest version of this. It's a deliberate move against the trend, designed to sweep liquidity and trick traders into participating in the wrong direction. Price dips down, induces a wave of sellers, grabs their stops, and that trapped flow becomes the fuel for the real move back up. It can involve one level or several, pulled from both the range and the pullback. The whole point is to get you leaning the wrong way, right before the actual move fires. Not all swings are equal. A low resistance swing is a failure. Price tried to extend and couldn't, so it left liquidity that's easy to take later. A high resistance swing is a clean non-failure move, a proper higher high or lower low. Here's the assumption traders work with. Once high resistance liquidity forms, price tends to travel toward the low resistance liquidity. In plain terms, the clean level forms and the failure level becomes the target. The market goes to collect the easy liquidity. When multiple swings stack up at roughly the same price, they merge into one deeper pool, equal highs, equal lows. And a deeper pool means a bigger surge of aggression when it finally gets triggered, because there are simply more stops packed in there. What's interesting is this is behavioral, not mechanical. It's almost a self-fulfilling prophecy of technical analysis. Everyone sees the same equal highs. Everyone parks stops in the same place, so equal highs become a buy-side magnet and equal lows become a sell-side magnet. Is a principle that'll change how you see indicators. Anything that produces predictable behavior creates exploitable liquidity. Take trend lines. Traders trust them, so stops cluster just beyond them, so a pool forms right there. Same thing happens with chart patterns, moving averages, Bollinger Bands, all of it. And here's the deception. The trend line trader expects a reversal off the line, but the break of that line often becomes continuation instead. The tool everyone trusts becomes the exact liquidity that gets taken. Now the opposite of a pool, the void. A liquidity void is a zone with almost no resting orders, and it usually forms during displacement. A fast, aggressive move that rips through price so quickly it leaves a gap behind. The fair value gap is the classic example. 3 candles, where the middle one moves so hard it leaves an untouched area. Price tends to come back and rebalance those voids later because the market wants to trade where it skipped. A standard gap is similar, but from a session break rather than pure aggression. Either way, voids get revisited. Now we cross over into order flow, reading the actual orders instead of inferring them. The toolkit splits into 2 classes. First, tools that show you the history of consumption. What aggression already ate. That's volume profile, footprint charts, and VWAP. Second, one tool that shows you the persistence of provision, where liquidity actually stays. That's the liquidity heat map, and it's the main event of the order flow method. History of consumption on one side, persistence of provision on the other. Volume profile plots, volume at price instead of over time, and it gives you 5 things to read. High-volume nodes are prices where tons of trading happened. Thick liquidity, price magnets. Low-volume nodes are the opposite. Thin zones price tends to move through fast. The point of control is the single price with the most volume, the fattest part of the profile. And the value area is the range where most of the trading happened. Read those and you can see where liquidity is dense and where it's hollow. The footprint chart cracks open each individual candle and shows you the buy volume versus the sell volume at every single price inside it. Instead of just a green or red bar, you see who actually won. How much aggressive buying versus aggressive selling happened at each level. And when one side massively outweighs the other, that's an imbalance. Those imbalances often mark hidden support and resistance because they show you exactly where aggression overwhelmed the other side. It's the most granular view of the fight there is. VWAP is the volume-weighted average price. Think of it as the historical equilibrium of all the executed liquidity, the center of mass. It doesn't define value, but it strongly influences it, because it marks where the most capital actually traded. That makes it one of the best support and resistance references you have, since it concentrates positioning and incentives. And anchored VWAP, dropped from a significant low or high, becomes a dynamic line that price respects as it develops. Capital gravitates back to the average. Here's the crown jewel. The liquidity heat map shows resting limit orders across price and time, lit up by size. But the real power isn't showing where liquidity appeared. It's showing where liquidity persisted. Think of it like buckets under a leak. A spoof order flashes and vanishes, but real liquidity stays, filling up over time. That persistence is what filters out manipulation. Spoofing shows up and disappears. Genuine resting orders stay long enough to matter. The heat map measures how long liquidity remains, and that's the tell. Reading the heat map comes down to two forces fighting. Absorption is when a big wall of resting liquidity soaks up all the market orders hitting it, and price simply can't push through. Provision wins, price stalls. Aggression is when market orders overwhelm the resting liquidity and blow right through the level. Consumption wins, price moves. Every level on the map is one of these two outcomes waiting to happen. Will the wall absorb, or will aggression break it? That question is the whole read. Liquidity shows up in recognizable shapes. A wall is a single large block of resting orders at one price. A hard line price has to fight through. A stacked wall is several of those layered together, an even tougher barrier, and a cloud is liquidity spread across a zone rather than one clean level, softer, more diffuse, but still meaningful. Walls tend to cause sharp reactions. Clouds tend to slow price down gradually. Learn the shapes and you can read intent at a glance. Two more forms, and they're about change. A liquidity withdrawal is when resting orders suddenly disappear, the wall vanishes, and price moves freely through where it used to sit because the brake got lifted. A liquidity flip is the order flow version of a support becomes resistance flip. A level gets broken, and the market remembers where the aggression won, so price reacts off that same level again from the other side. Liquidity gone means path of least resistance. A broken level remembered means price reacts there again. Here's where it all comes together, and this is the edge. Your best trades appear at the intersection of both lenses. Price action gives you the setup, say a liquidity grab sweeping a swing level. Order flow confirms it. That same level shows up as a wall or a stacked wall on the heat map. Now absorption overwhelms aggression, and you get a sharp reversal, with two independent signals pointing the same way. Integration is the whole game. One signal on its own is a guess. One confirming the other is a read. Let's distill the whole thing into 7 things to remember. 1. 3 orders explain everything. Market is gas, limit is brake, stop is nitro. 2. Price moves on imbalance. Market orders overwhelm limits and it moves. Limits overwhelm market orders and it stalls. 3. The visibility paradox. The visible order deceives. The invisible one sits in obvious places. 4. Price action infers liquidity. Swings, sweeps, grabs, runs, inducement, gaps, all the retail visible layer. 5. Order flow reveals it. Volume profile, footprint, and VWAP show consumption, while the heat map shows persistence. 6. Persistence beats presence. The heat map filters manipulation by showing where liquidity stayed, not just where it appeared. And 7. Integration is the edge. The highest probability trades sit where a sweep meets a wall and one signal confirms the other. That's the whole iceberg. Most content out there only scratches the surface. It teaches you to react to candles. But once you understand the mechanics, the orders, the book, the price action pools, and the order flow heat map, you stop reacting to price and start reading what actually drives it. Next up, we take all of this and turn it into real liquidity trading models. For now, congratulations. You can see the whole thing now.